welcome to Market Insights with J2Wealth. Today we have with us Mr. Shreyash Devalkar, the head of equity at Axix Mutual Fund. He currently handles across all funds over 2,20,000 crores. He handles majorly three funds, which is the blue chip, the mid cap, and the multi cap fund. He has an MBA and has a background in chemical engineering. He has over 14 years experience in fund management and about 20 years in the equity market. We're honored to have you with us at J2Wealth, sir.
Thank you.
In Q2 FY25, a lot of companies are given varied results. Some have been good, some have been bad. What do you think are the factors contributing to such a varied results among the companies?
Sure. Actually, quarter two of FY25 has been broadly continuation of last two quarters prior to that. The only difference being that effect of relatively the margin related slowdown has been more pronounced in these two quarters. So if you just go back the recovery phase post COVID, it came on the base of poor numbers during COVID years of 2021. We saw stupendous growth across multiple sectors, both on B2B side and B2C side, while there was a phase of margin expansion as well. What we have observed in last 2-3 quarters that there is a trend towards slowdown on the top line growth more because of the base effect, while market was or many companies were showing very good bottom line growth because there was a margin expansion as well. However, in these last couple of quarters, what we have seen is the margin expansion trajectory, which was there. Obviously, it did not keep on increasing quarter after quarter. So that has slowed down, and that's where you are seeing more misses in this Q2 compared to the earlier quarter. So what I would call it as absolutely the numbers are okay, but there were more misses in Q2 quarters compared to the earlier quarters.
So maybe there's like a short-term thing and we could see some change from here.
So if the growth expands, then definitely the margin should come back. We need to look at the growth across the sectors. So if you see multiple sectors, so the largest sectors in India, what is the financial services? Financial services, definitely the credit growth has come down. So that is having its toll on the financial services, apart from obviously the credit quality in retail. Then IT services, you are seeing the growth broadly in the large cap in mid-single digit. FMCG growth in large caps again is in the mid-single digit. So there are certain pockets where yes, the growth has been slow, while there are some certain other pockets like capital goods, etc. There the growth has been higher.
All right, great. In terms of the microfinance industry, we're seeing a lot of stress over there. Why do you think that is so?
See, microfinance industry caters to a segment of India. We have seen that more than the stress, actually, there has been a trend towards multi-lending, multiple one person or one family getting financial lending from multiple organizations. So such incidences might have led to asset quality concern in that sector. I think at the industry level and more importantly at the leaders in the industry at regional level, I think if there is a discipline on lending, I think this issue will come down.
Okay. Currently with the new US President-elect Donald Trump, the whole discussion has been on the tariffs that he would place, and currently we're coming to see that some tariffs are being placed to the Chinese and the Canadian markets, and including Mexico. Do you think this will benefit the Indian economy?
Whenever there is a tariff, actually, if you go back historically also, what was observed that what was the relative tariff versus them versus us.
Right.
And in that relative tariff, how competitive we are in manufacturing that particular item. We have seen that we have shown competitiveness in certain items. In the recent past, we have seen the exports in the power conductor, some of the chemicals in the refrigeration segment, etc. Those industries actually benefited. So it is to do with which industries in India are ready to take that opportunity, being competitive as such. The other repercussion sometimes it also has is their currency depreciates. The respective country where there
which we are seeing now as
where they have imposed tariff, and then you need to then look into it on a relative terms. after adjusting for the currency depreciation.
Okay.
And then need to assess the impact. So it is not only about tariff, it is about after that what happens to the response of that current country.
We are seeing now how your rupee is depreciating. So I mean, with the emerging markets majorly, it's getting hit.
Yeah, so hypothetically, if there is a tariff say on China, then whether the Chinese currency is depreciating. Now, if Chinese currency depreciate, then actually versus China, we become more expensive. So then, what is in that response how our currency behaves?
Right.
So this angle also plays a role. So it is not only about tariff.
Okay. So rupee currency will also play a role. At this current market juncture, what sectors do you think would perform the best from here on for the next few years?
Actually, since this market has been, so to say, roaring bull market for 3-4 years, every stone is turned to find opportunity. What we call it, it's a, so to say, discovered market. In this market, what you are finding is barring large cap. So large cap, as I highlighted earlier in the quarterly growth numbers, most of the large cap by weight, the heavy weights in the large cap have shown relatively lesser growth number, and that's where they are relatively cheap. While on the other hand, most of the mid and small cap are showing more better numbers, but they are relatively expensive. And when you look at this in entirety, then when you look at the opportunities are found either by relatively lesser valuations or more growth. In my opinion, the more growth, wherever it is there, it's fairly priced, or probably in some cases more than rightly priced. And in such a scenario, irrespective of the sector, actually individual companies keep on doing well. Whoever can show growth without much of the downgrades, because in this cycle of the market actually is looking forward to whether there are upgrades or downgrades in the numbers or not, rather than absolute growth. Absolute growth in this market is broadly priced in. If the company X is growing at 20% and Y is growing at only 5%, then the X is sufficiently expensive.
But do you
Now,
think
whether that company X, whether it will continue to grow at 20, or it will slow down to 15. Now, 15 is still higher than the 5. Okay. But that 15 is not sufficient because the expectation is 20. Okay. And that's where this market is more about that expectation versus reality, irrespective of the sectors. So that may happen. So even if you take case of say financial services, there are certain bank NBFCs which are there at more than 3 times price to book. It's more to do with the expectation versus their delivery, rather than absolutely one sector doing better than others.
Okay, so even the recent discounting also may not play much of a role. You can expect a little more of a discounting from here.
Yes, yes, we can expect more.
All right. Currently, you're coming out of the new fund offer, which is the Axix Momentum Fund. First of all, I'd like to understand what is Momentum Fund, and also what is your objective on coming out of the Momentum Fund currently?
So, Momentum Fund is about, it's actually some of these theories or some of these words are borrowed in the in the financial services from the science, right? So, momentum, as everyone understands from the science, so the words like momentum, volatility are borrowed from the science. So, when you look at momentum, what is momentum in by its definition? That's something which moves. It don't change its speed or direction unless it is acted upon, right? The same when you apply to the equity markets and the stock behavior. Then generally what we have observed is the stocks which keep on going up. They keep on going up unless there are certain problems in that, and generally the good phase lasts for long, and vice versa. Even the poor phase or bad phase also lasts for long, and company take time to come back. This is not only about price movement. It is actually mostly it is backed by the fundamental. If you take multiple cases like say telecom penetration in India, so that there has been a phase of telecom penetration. So month after month, quarter after quarter, more and more people used to buy new phones, and that penetration used to take a longer period of time, and that's where there was a momentum. Normally, underlying sectors momentum translate into underlying companies' earning growth momentum, and that's where it gets translated into the stock price momentum also. Okay. So if you just turn it around, it can go on the downward as well. When there is a slowdown, then the slowdown momentum translates into slowdown in the earning momentum, and then the slowdown in the stock price momentum. So these upward and downward movement of the stock is backed by fundamental, as I said. So either you follow fundamentals, you follow valuation, and then take a call, or there is one more approach that you use only one factor, which is a momentum factor, as a discipline to invest into. The underlying of this factor, as I said, is the fundamental end of the day. But you are not watching the fundamental, nor you are watching the valuation. You are only watching the outcome, which is stock price momentum, and investing into it accordingly. So this is all about the momentum investing, or the momentum factor in investing. This factor has worked very well abroad in US market. What we have observed. So there are, whenever the markets go up or down in a gradual manner, momentum factor captures it well. Obviously, whenever there are step jumps or gap ups, gap down, step jumps, then such market obviously is where, because momentum takes time to capture this, right? Where there is a sudden jumps or sudden down, then it may not capture. So one need to understand how it works for that, and how where it works. The reason for momentum is also that momentum fund or momentum as a strategy, what we have observed is it captures multiple styles. So when the growth stocks are in, or the quality stocks are in momentum, momentum can capture that as well, those stocks. Momentum get into value stocks also. So wherever there is a momentum can get into it. So it is not bound to one particular philosophy. Furthermore, since we are going to choose from 500 stock universe, so technically, and we will adjust it for liquidity, etc. But technically, when you're choosing from 500 stock universe, the momentum can buy into large cap, mid cap, small cap, all the categories. And that's what also is the additional advantage. So I would look at this fund as a momentum, choosing momentum as a factor, trying to invest into the broader market, and trying to position it versus a NSE 500 as a benchmark as such. So which is also a benchmark for broadly flexi cap kind of strategies.
Okay, so this is also going to be based towards that.
So these kind of funds are more to be compared. So you are using only momentum as a factor with the objective of comparing it with a BSE 500 or NSE 500 as a benchmark.
Like you mentioned earlier, like last 5 years we've seen a lot of growth. So Nifty was at 18,000, now it's come to 26,000, now it's discounted a bit. Do you think that there's a momentum to go on from here, from where the markets is, and how will you be selecting stocks based on that?
So momentum, as I said, can be upward or downward both. So it is not only upward or downward. So generally it is observed that upward momentum is relatively slow, while downward momentum is relatively fast. That's what is observed in the market. Here, more than the market, what the model is trying to do here is, you are going to select stocks from 500 stock universe, and first of all filter it based on the liquidity parameter, etc. And then having filtered on that, then you look at the momentum of a stock, particular stock, on a 1 month, 3 month, 6 month, and 1 year basis. Okay. Based on that momentum of the stock, then we also then you rate the companies or rank the companies on the momentum factor. We also are assessing from the risk parameter also. So there can be stock A which is having more momentum, better stock price momentum, but it is having more risk also. Right. While the stock B may be having lesser momentum, but it is having very less risk. So technically, one may suggest that if you are following momentum, you buy the high momentum stock. But the model is such that you are adjusting it for risk, and then if stock B, despite its lesser momentum, it is suitable, you are buying into it. So what this does is this try to reduce the volatility. Okay. Because when you buy totally momentum, then it increases the volatility. Secondly, since we are choosing from 500 stocks, more number of stocks, the lesser is the volatility. Because if there is one index which is a momentum 30 index which chooses from 200 stocks. Now when you are choosing only 30 stocks, then it becomes like a focused kind of one. Right. So then obviously all the risks get animated, or it gets so that's where when you're choosing say 40, 60 stocks or more, then it's a more diversified. So such things when you do, then thereby you try to reduce the volatility. Obviously momentum as a strategy definitely is relatively high risk strategy. So on a risk parameter, momentum as a strategy is a risky strategy, that one should understand.
All right. I think that was a really useful discussion. Thank you so much for your time, sir.
Thank you.